Ladies and gentlemen, I've listened to the SoFi earnings call twice now, and there were a lot of details that I picked up the second time around that I didn't end up seeing the first time. Maybe that's for you guys as well. So, in this video, I want to go through a fast presentation about all the things that you potentially have missed from the SoFi earnings of Q3 2025. First up, if we don't know, SoFi ends up beating guidance once again. This is so clear. This happens every single quarter. We get a triple beat since they've been a public company, but this time actually extended that growth. If you look to revenue, this was actually one of the largest beats that we've seen from the company at 11.8% beat, then a 23% beat on EBITDA, and then nearly a 40% beat on net income. It usually is in that order, smallest being revenue, highest beats being from net income, but overall, significant triple beat once again. The triple beat, by the way, does not come from EBITDA. It comes from guidance, but guidance was also raised from 31 cents to 37 cents. And to put this into perspective, how the company is growing over time, I wanted to show you guys this quick little reference sheet that I have for each quarter and how the revenue, contribution margin, adjusted EBITDA, and net income has gone over time, all looking in positive directions as we continue to scale the business. The way that the revenue splits out is now more than 50% is coming from contribution profit, where just around 50% is actually coming from those same targets. Now, funnily enough, if we actually go over to the contribution chart like this and actually look at the margins, this is the first quarter where financial services actually has a higher margin than lending. A little bit due to financial services continuing to climb in their margin, but also lending slightly decreasing in their overall margin, and financial services being heavily fee-based. So it's actually worth it more to investors to realize that there's no risk on the other end if they mess this up. But if you end up looking, financial services used to be a negative, like deeply negative contributing segment of their business, now being the most profitable in the entire company. Next, I wanted to talk about guidance for 2025, where they ended up bringing up member growth of at least 3.5 million, or approximately 34% growth from 2024 levels. This actually ended up showing, if we add up the last 3 quarters, that we got to 2.5 million total members for the last 3 quarters. But in order to get to that at least 3.5 million, we're looking at nearly a million new members for Q4, only needing about 15,000 more members. We're probably going to see our first 1 million member quarter in Q4 2025. For guidance for 2025, it was across the board a raise, right? So from adjusted net revenue to adjusted EBITDA, net income, diluted EPS, and tangible book value growth, all having severe growth rates. But if we end up seeing from 2024, the growth rate that we ended up seeing was 35%. So now, year over year, they're expecting full year 2025 to come in at 36%, an acceleration in growth rates year over year. On top of that, net income margin also accelerated. So you're expanding margins while also having expanding growth rates. That's going to lead us to have, higher prices that people are willing to pay for SoFi stock, meaning the stock price increases as well. SoFi stock always triple beats. So my opinion of these guidances is that each and every one of these statistics, from 2.5 billion additional dollars in tangible book value to 3.5 billion in revenue and 37 cents of EPS, is all going to be beaten next quarter. We're possibly going to see 38 cents or above, potentially 38% growth in revenue. So all of this is all going to get beaten if you look into their historical past, where they've done that every single quarter since being a public company. Now, one of the easiest ways to believe that they're able to do this is just based on their capital ratios. If you look at their total risk-based capital ratios, now at 20.2%, which is historically probably one of the highest levels that they've ever seen. And this is because of that large tangible book value, where they ended up diluting a lot of shares. But what this ends up meaning is that they can grow their loan book by essentially 6 to 7x what this ratio is at, because they can lend out at a multiple of how much capital that they're actually holding on their balance sheet. At the minimum, they need to keep around 10.5% in cash, in cash equivalents, to end up paying off for the loans if they start to go default. But we're essentially double that. So this can come back down from 20% all the way down to 15% without sparking any concerns or any negative press. But that amount of growth could lead to explosive levels of revenue growth and EPS next quarter if they start to accelerate in October, November, and December. And this is what this looks like. Whenever we end up looking at tangible book value, look at the spike here. All of this essentially points to more loan growth, which is end up going to lead to better results for the quarters and years ahead. In my expectation as well is next quarter is not going to see a drop here. We're going to see continued growth, which is only going to allow them to expand even further on their loan book. Another reason to potentially believe that we are going to see even more growth than people are expecting is that net charge-offs, their actual quality of their loans are constantly getting better across every single segment. Home loans, student loans, and personal loans all getting better, which means that they can even go out, borrow more, get paid more for those loans, and then, start the cycle over and over again. And the fact that they are raising their fair value of these loans sparked a lot of bearish concerns from Wall Street saying, hey, you know what? They're artificially raising the prices of these loans, and that's actually affecting their revenue. So we think that whenever that starts to turn negative, that's going to be a bad sign for SoFi. But then in blue here, you can see how they've sold their loans. And just in the most recent quarter, which was the second highest level that we've ever seen them sell their personal loans at, 106.4% gain on sale margin, this essentially means that their fair values are not high enough. They are actively selling it at higher rates than their fair value marks, which means that their book is even worth more to other institutions than what SoFi is saying they're worth on their own balance sheet. That's very good signs. Imagine a car dealership saying, hey, all of our cars are priced at $20,000, and then people are walking into the store and buying them for $25,000. If you were to go back and look at your inventory and say, okay, well, what's our total inventory worth? Are you basing it off the $20,000 sticker, or should you be basing it on the $25,000 actual sale value? So SoFi is actually marking their loans much lower than what people are willing to pay for. Now, to fully understand the SoFi story, you now have to understand the loan platform business. This is going to be a major part of their future growth. Over the last 5 quarters, they've started a new type of loan that actually allows them to originate loans on behalf of other institutions. This has gone from a $1 billion of originations per quarter all the way up to $3.4 billion of originations just in a year-over-year perspective. So this was Q3 of 2024 to Q3 of 2025. They've 3.4x'd their amount of originations that they're giving out to other institutions. And already that makes up for more than 45% of their overall personal loan originations. Now, if we just isolate this alone, you can see that growth per the amount of total originations that they're doing, skyrocketing, more than doubled in the last year. The take rate has gone from 4.24% at a high of 4.7, and then now even higher than their original year-over-year target, 4.32%, meaning they're pricing better, they're originating 3.4 times more, and as a percentage of total originations, that's more than 2x, essentially a 2.25x of where they were before. And probably the most bullish sign, this is only for personal loans right now. And that was highlighted in the earnings call. Are there opportunities in the loan platform business for non-personal loans? And Anthony Noto said, there are definitely opportunities in the loan platform business for non-personal loans. Chris and the capital markets team are working on that. So they're potentially looking to expand the loan platform business out to student loans, probably first, and then eventually home loans. And they're already actively working on that to accelerate their amount of originations and find buyers for those loans. And remember, it's not just about the growth of these loan businesses that makes me excited. It's about the quality of the revenue. This is completely risk-free, which means that institutions that look to invest in SoFi stock will actually see that there's a lot less risk in their loan business, and they're really just taking fees for service here in originating loans on behalf of other institutions. Now, regardless of if their quality of growth is even getting better and better over time, we can also see from a rule of 40 perspective that SoFi continues to improve. This is their third best quarter that we've seen over the last many years at a 67% rule of 40. Or a rule of 67. This is absolutely amazing, and it's really spread out. It's not like we're just seeing revenue extremely high with very low margins. It's almost the closest 50-50 split that we've seen, while also being at the highest rates that we've seen, which means that they can accelerate revenue while also accelerating margins. The two S curves that you want to try to grow at the exact same time gives us the best multiple as being a business. I didn't pick this up the first time, and in fact, it wasn't actually in the earnings call, but Timothy Sweeney on X actually noticed that in their CNBC interview at the very end said that they're expecting the SoFi stablecoin, SoFi USD, by Q1 of 2026. That was very exciting to see. So, what I'm expecting is they're going to be the first business to end up getting into buy, hold, and sell crypto in Q4. And then in Q1, they're going to start opening up their own stablecoin, an L2 on an original L1 blockchain to help facilitate payments, increase margins, and then get into international business as well, like paying to Mexico and Europe, and then potentially even expanding into other financial services in those countries as well. Now, you might have seen their total deposit base actually ended up having a really big increase this quarter, especially if you look in the dark blue. We ended up seeing quite the large step up this quarter, but also quarter over quarter, we saw deposits per member take a slight increase. The fact that they're even able to hold this up while growing members at essentially 900,000 over time is just absolutely incredible. And then on top of that, where the money goes because they're switching over to SoFi Plus is also expanding. You end up seeing growth continuously stepping up. It won't always continue to grow on a spend per account basis, but we're still seeing that growth today. And the total amount of spend per quarter is still sitting at about $4.9 billion a quarter. And with that, SoFi is finally getting some love from Wall Street, and it's almost across the board. Even the sell ratings here are upgrades. 18 to 20, 26 to 28, 21 to 23, 24 to 27. Okay, upgrades across the board. But then on the bullish side, we ended up seeing 31 to 38, 28 to 37, 29 to 36. Those are the ones that I will actually look to more often. We haven't even seen Devin Ryan post his price target yet. He did give an update. He was extremely bullish on the stock, just no actual price target still. But overall, what these institutions are seeing is exactly what John X saw in his report. Q3 beating across originations, member growth, and fee-based revenue. 2025 guidance raised showing upside for Q4 versus expectations. A refinancing market, crypto market, and stablecoin expansion should lead to the next leg of growth. And a transition to a capital light model should enhance return on equity potential. Those are the four places that Wall Street is paying attention to essentially across the board. And they ended up upgrading their share price to $35 by next year. Now, I'm not too concerned about the actual price target that Wall Street's putting on SoFi. They've been behind the ball since the stock was $4 a share, and they were giving price targets at $2.50. But it is still exciting to know that they continue to reaffirm and change their targets on an upward basis. They can't really find a bear case at all. They don't see anything underlying that's tearing down the business, and they see the potential of transitioning to more of a capital light business model. Now, all we need to see is for Anthony Noto to execute on that plan. I'm a huge believer and continue to be a very bullish shareholder. So excited about this quarter and what Q4 holds next, especially going to be able to see 2026 guidance next quarter. That's going to be very important for the stock as well. But ladies and gentlemen, thank you all so much for watching. I really do appreciate your time. Make sure you subscribe. Bye for now.